A very warm welcome to our learners today in your audit and assurance class. My name is Ngandaro Joseph, and let us get on into it. Today we are going to focus on audit evidence, specific areas of course, and I would like to look at cash and bank, how to verify amounts for cash and bank, and as well as how to deal with liabilities, capital, and directors' emoluments as far as audit evidence is concerned. So let us start with the verification of bank balance, and you want to take down some notes so that as I go through this work, you can come up with questions for further discussions. When verifying the bank balance, we need to know what we are trying to achieve in terms of audit evidence. The audit of bank and cash will need to cover completeness, existence, rights, as well as obligations, accuracy, valuation rather, and allocation and presentation. All these elements can be audited through what we call the bank letter. And of course, this is the standard document. Standard bank letter is a letter that we send as auditors to the bank to request that the bank of our clients confirm the closing balances of a particular financial year, if a particular period, if you may like. It may not necessarily be a financial year. So when we do that, the banks will require that we obtain explicit written authority from the client. Remember, they've got a duty of confidentiality to honor. The auditor's request must refer to this, and that the request must reach the bank at least in good time, not at short notice. That is at least a month before the end of the financial year. Under your audit procedures, under there you are trying to obtain confirmation about the year-end balances. Of course, you want to check the maths accuracy of the bank reconciliation as well. You want to trace checks shown as outstanding to the after-date bank statements to ensure that there was no, leading and lagging. We've called that so many times in financial reporting. You want to trace receipts shown as outstanding to after-date bank statements to ensure that these were genuine and that these were received. These are, outstanding, lodgements. Under cash in hand, if cash balances held by the client are material, then you may have to do what is known as a spot check. You want to attend what we call the cash count to ensure that the amount that has been put in the trial balance, that is going to be put in the trial balance, is correct. Okay, so you need to do some bit of planning, before you attend your spot check. At least you can think about the time and location of the count, who is to be present. Of course, the auditor must be there and one of the client's staff. You need to inspect the cash book to ensure that it is written up to date and is in ink, of course, signed, so that when we do the count, we're able to verify against what has been recorded up to the moment. During the cash count, the cash balances held in the count rather of the cash balances should be done in front of your client's employees. What we're saying is the auditor should never be alone with the cash. That is reckless, so to put it. You need to inquire into any IOUs, and of course IOUs mean this money that belongs to, let's say, the paid cashier that has been advanced to members of staff. If you don't inquire on these, of course, you're going to find that there will be a serious difference which you may not reconcile. Confirm cash balances agree with the financial statement amount so that you can check for what is known as completeness there. Okay, After the cash count, what should you do? You should ensure that certificates of cash in hand are obtained as appropriate, and ensure that unbanked checks are subsequently banked. Check that that is done, then agree to bank reconciliation for the forthcoming month. Then you should ensure that IOUs have been reimbursed, and of course this will be the responsibility of the client. After the cash count, you may have rather to do other things. You ensure that IOUs or cash checks outstanding for too long have been provided for, because these might not be received. And you should ensure that all balances counted are reflected in the accounts themselves. So of course we are done with cash and bank. Let us now get on to payables. Auditors should be aware of the possibility of the understatement of liabilities, and of course here we're dealing with payables. There are two detailed objectives under the verification of payables that you want to confirm. You want to confirm if the liabilities pertain to a given period, that is the cutoff, has been respected. And you also want to confirm that trade accounts payable represent the bona fide, obligations of your, clients. What are some of the procedures that you want to undertake here? To confirm that the listing has been, you must confirm rather that the listing has been extracted. The listing in this case means the, payable ledger, subsidiary accounts, balances. Listing has been extracted correctly from the purchases ledger. You need to reconcile, you need to check that there's been reconciliation between the ledger accounts and the control account. You need to recalculate the sum of the list of balances, all right, to ensure that there's accuracy. And under completeness, rights and obligation, as well as existence, the key test is a comparison of supplier statements with the purchase ledger balances. Of course, supplier statements are third-party, reminders of outstanding invoices to your client. However, it is sometimes necessary to secularize, to confirm externally, these balances where you have got the following. Let me just... Right, so what are some of the circumstances there? I go to circumstances where there's need for secularization. There is this situation where supplier statements are not available or they're incomplete. You may have to do secularization. That is confirmation with a sample number of your clients, suppliers. Where internal controls are weak, material misstatements of liabilities is feared. As a consequence, you want to do secularization. Confirm the outstanding balances of suppliers with the suppliers themselves. The way you have got suspicion that the client is understating payables deliberately, I think you may want to do some confirmation. Okay, now under payables again, as well as expenses that of course we incur on credit, you want to check for occurrence and completeness. That's an accession. Did the transaction take place? And all the transactions recorded that were supposed to be recorded in the books of your client. So what are some of the things that you can do? You can do what we call analytical procedures. And of course, you remember this is simply trend analysis. You need to consider the level of purchases, expenses on a month by month to check whether there is a uniform increase or uniform decline. And of course, all, quantum, changes must be subject to further investigations. You need to check for the effect of quantities purchased. If more quantities were purchased during the year compared to last time, what will be the effect of this? Of course, we expect our payables to increase, but if they don't, then there's a problem. You need to check for effect of changing prices. If there's inflation in the land, we expect payables to go up. If there's a decrease, we need to find out why is that so. There must be also an idea of the ratio of purchases to trade payables, the expected margin, of course, that you need to see there. And if there is a big variance, you want to ensure that that is followed up. Ratio of trade creditors to inventory, again, you want to bring some expected value there so that if what you have is different from what is shown, you want to make some further investigations. Under cutoff, you want to ensure goods from the last goods received note are included in the ledger or list of accruals, and you want to review the schedule of accruals to check that goods received from the year end, goods received rather after the year end, are not included, because these will be expenses for the following period. You need to review invoices and credit notes after the year end to ensure that these those rather relating to prior year are included within the payables, because the liabilities incurred upon delivery. You need to reconcile batch posting around the end to ensure that invoices are posted in the correct accounting period. Okay, accruals. As a general rule, accruals lend themselves to being audited by analytical review, as well as they should be comparable to prior years. And of course, what are some of the works that you can do surrounding accruals? You need to recalculate accruals and trace back to supporting documentation. All right. You need to review ledger accounts to ensure that all accruals have been included at an appropriate amount. You need to scrutinize post-year end payments to see if any should have been accrued. And then you need to consider basis for round sum accruals. And of course, it is here where there's potential for fraud. So we need to ensure that the round off sums are within what we call expected margin. All right. The tax accrual itself. You need to do some bit of work on the provision for income tax there. You need to ensure that the income tax in this respect is correctly calculated. And how do you do that? You need to agree to the previous period, agree the income tax expense computation to the previous period tax charge or credits, the current period tax charge, and amount paid to the tax authority, and the amount paid to the tax authority. All right, so I think the weight charge there looks much more better, and we can do better than that. Let me just control there. Great. So under sales tax, you assess reasonableness to next return, verify amount paid in the cash book. You see, whenever we make payment for these tax amounts, we indicate that the amount that has been paid in the cash book, so that can still be verified. Under wages and salaries, we check for completeness and valuation. Procedures will give some assurance on pay liabilities as to how accurate the number that has been put in the trial balance is. But you as auditors, in order to gain some bit of confidence as to how whether that number is accurate or not, you need to carry out some tests. So the tests may include agreeing remuneration payroll to personnel records. You need to confirm existence of employees by meeting them, at least even on a sample basis. You need to perform calculations on the payroll to check for accuracy. You need to agree validity of deductions to support documentations. And you need to confirm that the net pay against bank transfers. So we have got long-term liabilities as well that we need to work on. And of course, the objective of our audit test here is completeness, accuracy, valuation, and allocation, as well as presentation. Now, of course, completeness has to deal with did all the transaction get to be recorded. And then we have got also accuracy, valuation, and allocation. We need to check whether interest payable has been calculated correctly and included in the right period. We need also to check whether the presentation of long-term liabilities has been properly done, especially in line with when you consider what we call convertible financial securities. So what are some of the audit procedures you're supposed to do? Obtain or prepare a schedule of loans. So if it's not prepared, you can still do that. You need to agree opening balances to prior year and recast, meaning recalculate for accuracy. Then you need to compare the balances to the general ledger, again for completeness. You need to verify lenders to any register of lenders, e.g. debenture holders, to confirm rights and obligations. You need to trace additions and repayments to cash book to confirm, occurrence of payments under this obligation. You need to confirm repayment, whether repayment rather conforms or is in line to agreed, provisions in the, loan contracts. You need to verify borrowing limits as per articles, so that these are not exceeded, because if these are exceeded, then the company's risk profile is intolerable, it cannot be tolerated. Financial risk is high. You need to obtain direct confirmation from lenders. Of course, in cases where you want more assurance to the accuracy of numbers, then you need to review minutes and cash book to ensure that all loans have been included. Right. Let us check the provisions and contingencies. A provision is a liability of uncertain timing and amount, and of course I think there's potential here for abuse because provisions are subject to estimates. A contingent asset, on the other hand, is one that is a possible asset. A contingent liability is a possible liability, arising from past events whose existence will be confirmed only by the occurrence of one or more uncertain future events not fully within the entity's control. Now, provisions are not to be recognized, contingencies rather are not to be recognized because these are, their existence depends on what would happen in the near future. What are some of the procedures that you need to do as an auditor? You need to obtain details of provisions and contingencies, review correspondence, and I would like to mention here that you can use the auditors, the auditors of the, not the auditors, but the lawyers of the company. You need to discuss the reasonableness of these provisions with directors. You need to ascertain whether payments have been made in respect of provisions in the subsequent events period. If payments have been done, then it means that the provisions are, authentic. And then you need to review correspondence with solicitors pre and post year ends. Okay. Great. You need to consider past provisions, whether they were subsequently, required, to check reasonableness of provisions. You need to recalculate all the provisions to ensure that these are correct. You need to ensure that disclosures made about contingencies are complete and accurate. All right. You need to consider the nature of the client's business. Would you expect to see other provisions, for example, warranties? All right. So all those things should be checked. Should be checked. All right. So let us proceed to the next slide, which discusses share capital. Auditors should ensure that the directors have observed their legal duties in regard to share capital and reserves. For example, we need to see to it that undistributable reserves have not been distributed. Otherwise, license requirements might be breached. Agree authorized share capital to the memoranda of the company. Verify share transfer details and cash payments to cash book. For accuracy, agree dividends paid to cash book and to the minutes of the AGM where the dividend was proposed. For completeness, you need to check calculations of movements on reserves to see whether these were accurately done. Under directors' emoluments, auditors should ensure the disclosure of emoluments is adequate, is complete, is accurate, and is compliant with applicable accounting standards and local legislation. You need to agree details to payroll records to check whether those obligations are actually paid. Review directors' contracts, ensure that amounts paid are in line with what was agreed. You need to review minutes of board meetings for any changes to directors' obligations. Thank you very much for listening, and I want you to come up with questions. For our students, of course, we will provide you with question practice. Thank you very much, and let me know if you have got any questions.